Ever wondered how a traditional industrial company becomes a market leader by shifting from B2B to a consumer-facing brand? Today, we are doing a deep dive into the Q3 FY26 earnings of KEI Industries, a company currently defined by surging margins and a massive cash-rich advantage. Let's look at the snapshot. KEI reported revenue of 2,955 crores, up 19.5% year-on-year, while profit after tax skyrocketed by 42.5% to reach 235 crores. What is truly impressive is their fortress balance sheet, sitting on a net cash position of 1,267 crores. This is a clear case of the operating leverage effect. While revenue is up roughly 20%, EBITDA jumped nearly 40% due to an improved product mix and efficiency, resulting in an earnings per share jump of 37.5% to 24.57 rupees. When we look at margin mastery, KEI expanded its EBITDA margin by 169 basis points to 11.98%. This was driven by better realization per unit and strict cost efficiency, while finance charges dropped to a negligible 0.56% of sales. The real profit engine here is the cables and wires segment, which brought in 2,821 crores in revenue. Interestingly, the stainless steel segment saw negative growth, meaning the core cable business is driving nearly all the company's profitability. KEI is winning the retail game by making a strategic shift from B2B to a consumer-facing brand. Dealer sales surged over 29%, and this network now accounts for 54.5% of all cable revenue, providing stickier revenue and better working capital cycles. On the institutional side, export sales surged a massive 95.1%. While the EPC segment grew by 81%, it operates on very thin margins of just 1.23%, meaning it has a high revenue impact but minimal profit impact. The big catalyst for future growth is the Sanand Greenfield unit, where Phase 1 commercial production for LT and HT cables has now commenced. This marks the transition from a capex cycle into a production cycle that unlocks volume growth for FY27. Financially, the company is in a position of extreme strength, with a net worth of 6,420 crores and gross debt of only 153 crores. Being virtually debt-free means they are fully self-funded for future expansion. They're even rewarding shareholders with a dividend of 4 rupees and 50 paisa per share. This payout at 225% of face value is a strong signal of management's confidence in their liquidity, despite heavy capital expenditure. However, every smart investor monitors risks. We've seen an inventory buildup of about 30% since March, reaching 2,256 crores in December. While likely intended for the new Sanand plant, we must monitor if this unwinds into sales in Q4. Other risks include commodity volatility in copper and aluminum prices, which impacts gross margins, and new labor codes that triggered additional provisions of 11.6 crores. Also, fast EPC growth at thin margins can dilute overall quality. That said, revenue visibility remains strong, with a pending order book of approximately 3,928 crores. This provides revenue assurance for the upcoming quarters, independent of the new Sanand capacity. The final verdict on KEI is constructive. You have a high-growth company with a high-quality balance sheet, expanding margins, and a retail network that is hitting its stride, balanced against a temporary inventory spike and low-margin EPC growth. If you found this deep dive useful, subscribe us at ZinvestZ for more breakdowns of top-performing companies. Thank you.